All right, guys, thank you for joining. We're going to have people coming in here for the next 5 minutes, I imagine. We're up to almost 100 people. And this topic is going to be a roundtable discussion about housing analytics. Housing analytics, how the sausage is made. And I think we're going to get going. I don't want to penalize. Yeah, that's right. I don't want to penalize people for coming on time. And this is being recorded. So let's get right into it, guys. I love this group right here. We're going to start with some intros. First, we got the president and CEO of Miller Samuel, self-proclaimed master of the universe.
I don't know about that, but
oh, come on.
Self-proclaimed.
He knows what I'm talking about. I got recordings of this. Okay. The only data guru with hair.
Yes, this is true.
Am I getting this right?
You are.
I mean, I don't know what he did different than us. I mean, you could see the effect it had on us.
Yes. There. No gray hair, by the way. Yeah. So
a little help from someone on that, a little just for someone. Well, I'm not going to go there. Okay. The one and only Jonathan Miller. Thank you so much for joining, Jonathan. Please take 30 seconds, Jonathan, and tell everybody what it is you do.
Sure. So I'm the co-founder and president, CEO of Miller Samuel, which is a real estate appraisal firm that covers the housing market in New York City Metro and certainly the Hamptons and Fairfield and Westchester. And then something that I've been doing since, I don't know, the mid-90s is an expanding market report series for Douglas Elliman. So I sort of see myself as a real estate appraiser / market analyst. Perfect.
That's how we all view you too. Let's now move on to our second guest today. We got Kael Goodman. Kael Goodman. I love Kael. Love me some Kael. Not only healthy, but great for you in general, right? Good with
I never
stuff
heard
on the
that
side.
joke before.
Yeah, never. It runs Marketproof. If you haven't checked out Marketproof, check out Marketproof. It is new development data on steroids. He has so many tools.
Amazing.
So many tools. Kael, take 30 seconds.
Yeah.
Tell everyone what it is you do.
Great to be here with you guys, of course, in the round table. Marketproof is basically, we're a software company. It's subscription based. Our first product was Marketproof New Development, which has been around now for a little over 2 years. It's a deep dive. It's a B2B tool. It's for people in the business. It's not really a consumer tool. And you can go to marketproof.com. You can subscribe to that. And then we have a new tool out in the market just last month called Marketproof Pipeline, which was something a lot of our customers asked us for. So we put our heads down, we made that, and that covers all of the kind of construction activity in New York City. What's coming up, who's behind it, what is it? And that spans across all asset categories, residential and commercial. That's my pitch.
Yeah, thank you for sacrificing your blood, sweat, and tears. I know what it's like to do this corner of the market. I mean, if you're doing business in that sector, we don't have the data you have. You know what I'm saying? It takes a lot to do it. So props, good job. Go visit Kael and reach out to him. He'll help you. So that's important too.
Yeah.
Let's get started with the webinar. Yeah. Let's jump right in.
Well, first I want to know what you do.
Yeah.
Tell me what you do.
UrbanDigs.
Oh, come on.
I should have.
Come on. You too.
I should have said something. Okay. So UrbanDigs. So we are basically we're trying to think of ourselves as a neutral, independent data source. We figured there's a good niche there. There's a lot of bias when it comes to buyers and sellers listening to their brokers tell them what to do, raise their bids, lower their asks. So we're trying to build all of these tools and basically provide intelligence, market intelligence, market insights. But this is a good segue into the first question, which we're not going to spend a lot of time on, but it's important because there's a lot of resources out there. Right. And I think we got Miller Samuel, we got Marketproof, we got UrbanDigs. I think there's people out there that don't understand what it is that we do and what differentiates us. So Jonathan, could you just spend a couple of minutes? We're going to go start with this and then we'll get into the good stuff. How is Miller Samuel different from UrbanDigs or Marketproof?
Well, besides having more hair, I look at us as we're not a software company, we're analysts. And so what we're doing is We're providing opinions on property values, and we're also giving what we think, as an appraisal firm, we do a lot of litigation, we do a lot of court testimony, and the majority of our, for example, our matrimonials, we're over 90% of our engagements, we're hired as a neutral party between, the husband and the wife, or, the two, partners that hate each other. We're seen as neutral, which is what, Noah, you used, and I think of Kael that way. To me, neutrality is everything in what we do, to the point where with my market studies, we release them. One of the things when I started doing them in 1994-ish is originally everything that I released when we first started, the news outlets wanted the exclusive, which seemed patently non-neutral, right? Because this publication wants it, but you can't give it to the other ones. And so we never did that. And what we did is create this embargo system where, because print media and online media, online has the advantage. After they interview you, you can then just put it online, and print they can't. They have to wait the day for it to go to print. And so conceptually, when we push out information, we do it in a way that is perceived as neutral, because that's kind of all we care about. That's the sort of the basic ingredient of everything we do.
Well, I think just to jump in here for a second, I mean, that's what all three of us do. We're all
exactly
independent third parties in our own ways, right? Even though you, Jonathan, you're affiliated with Doug Zelman, you operate as an independent third party.
Yes, right? Yes, to a fault.
Doing your own stuff, putting it through their channels, right?
Yep.
And Noah, you and I are independent companies. We're not affiliated with brokerages, and we're all independent. And this is something that people come to us a lot for. We're a software company. We what's different from what Jonathan is doing versus what I'm doing, whereas he's building trends. A methodology for doing. I know I'm taking your line here.
No, that's okay.
We do trends just like you do, Noah, but we enable people to look at like very specific things, like how many units are in this building, how many of them are sold, what was the discount that somebody got or a group of units got compared to what the original asking price was. So we operate in a very granular way, and then we build that up to more trends. But our focus is not so much on the trends, but the individual pieces of data that generate the
right, whereas mine's more sort of trending, what's the trend, what's the direction of the market, as opposed to the absolute sort of how many jelly beans are in the jar kind of.
Right, we're counting jelly beans,
and they're in my office there's not a lot of jelly beans left, so
okay.
Anyway, sorry. No,
no, it's okay. Kael, I look at you and there's a lot of information out there. It's such a disparate world of information.
Mm-hmm.
It kills me. It doesn't have to be this way. There could be some cooperation, but because of the way this industry has brought itself together over the last 3 decades, everyone's very careful to protect what they have. And nobody wants to share what they have. They're because it's that secret sauce of how they scrub, standardize, normalize, merge, and fix all the data depth and integrity problems. I look at you as filling in that missing gap with the Schedule A's of all the new developments. Asking prices, all that stuff that you can't get in the typical data streams of revenue RLS. And then you come up with these outputs that you normally wouldn't get. And I look at you in terms of when you're getting granular, you're getting all that extra information, and then you're able to slice and dice it. Whereas other firms that are using the public data and the private data streams, we have to we're very limited.
Right.
Well, the Schedule A stuff is theoretically right. So what Noah's talking about, just for background, in new developments, there's an offering plan, and in that offering plan is a Schedule A, and the Schedule A details all the units in the building, what percent ownership they represent, how many bedrooms, bathrooms, and what basically the sponsor is asking for that unit. And I talk about this all the time. There was this great article in 2019, which talked about shadow inventory. Jonathan was, of course, in that article, and some others. And it just kind of, triggered this aha moment for me that this information was still not very visible. So, during COVID, we said, all right, let's, we had some free time in our hands, like a lot of us. And we said, can we use some software to extract this information from these Schedule A's and try and make sense out of it, in conjunction with all the other stuff we do. I know we're all talking about AI a lot right now with this, Chat GPT, sure, everyone's minds, but, this AI stuff has been around for a while. And we use some kind of AI tools to extract this stuff. It's called text extraction. And you just, you point it at a document and it pulls all this stuff out. So we've been doing that stuff for a while, and then you build that up with a bunch of other software and you try to figure out how to display it on the screen and make it, usable for people.
That's so different. That's so different than mine's. Our approach was over like 20 years. Or 30 years, we collected every Schedule A, every offering plan we could get our hands on. We have about 4,500 building files. And I don't know, 10 years ago, we started scanning it. So I've got everything, but not in the way that you do. So that when our appraisers sit down, they can look at the Schedule A of the comps. Like they can look at, and not just new construction, but Park Avenue, share allocations, older stuff that when you could buy, something on Park Avenue, an 8-room apartment for $15,000, and it was the most expensive unit in the building. But just for context, because we do a lot of share allocations for co-ops, we praise a ton of hallway spaces for co-ops. Come up with a value for buying the end of the hallway, roof rights, like all kinds of the smell of the Starbucks that was improperly vented, and now your apartment smells like Jamaican Blue Mountain blonde roast. What's the impact to a $5 million apartment? Tons of that kind of abstract, and we get that through collecting all this data. But you're doing the same thing, but in a completely different way.
For a different reason.
Yeah. And the way I look at this with what we're trying to figure out is, so you're collecting it for granularity purposes and reporting. Jonathan, it sounds to me like is on the trend.
Yeah.
The trend side. And the way we look at it is interpretive talking points, interpretive messaging, like actionable messaging for buyers and sellers.
So like sitting down at a Starbucks and you're basically enabling a broker to talk about the market to their customer client. Is that what you mean?
I feel there's two problems. I feel there's one problem in terms of interpreting the charts. That in and of itself is very tricky. It's very hard. Not everyone can do it. And who has time to do all this kind of stuff, right? That's kind of relies on our shoulders, on all of our shoulders to kind of do this kind of stuff.
Right.
And the second thing is, what do I convey? What's the message that I ultimately convey to buyers and seller clients? If this market's changing and leverage is peaking and troughing and going up and down to each side, it's the interpretive message and making that as easy and digestible to understand, which is
know what
so
to
hard.
do. Yeah.
Right. Yeah. There's so much. So one of the things I find is because there's so much information out there, right, that it almost sort of analysis paralysis, right? And so I see in many ways, my role at Miller Samuel is more macro, like, in terms of the market reports, not the property valuations, where like we're more macro, like what is, where are we floating into, what does it look like? What does 23 look like?
Well, but let's be honest about this, Jonathan. The things that you say move the market. Let's just be real about it. Noah's helping people individually figure out what to do, how to represent a client, how to price something, right?
Yeah.
It's not what you do, Jonathan. I mean, you came out with, and I'm just, you and I just had a conversation about this, about the rental prices and the median, and that moves the market, right? It reverberates across all of the media.
Yeah, well, you're basically trying to give proper context to the data, which is what Noah does, all day long, like trying to sort of, I don't know, explain it in a way that is digestible, that people can, because I just remember one of the examples when I think about, you have all this data, and then you have sort of people have biases in terms of, hey, it's always a good time to buy, it's always a good time to sell, that sort of stuff. I remember at a conference in Long Island after Lehman collapsed, and I remember a real estate agent or broker that was sitting next to me was like, just said, hey, everything's great. It'll just be a month or two, this a little crazy, and we just go back to normal, very confident. And so that works for like a month, right? But you're not giving people the tools to navigate what ultimately is the actual market, not the sort of the fantasy market. Yeah. And that's how I see you guys. Like, how do you navigate it?
Sorry, go ahead. I mean,
no, go ahead. Yeah.
I was going to say, this is going to be a wild year in terms of navigation. I think we're as complex and mysterious today as we've been in a long time.
Many head fakes, right? The market is
head fakes, right?
Yeah, and I think one of the problems is what do you look at? Like, you got closed sales data. All right, and Jonathan, I'm going to ask you, closed sales data. That doesn't tell you what's happening today.
No.
That tells you what happened 4 to 6 months ago. This market's changing. So now we have everyone looking at these closed sales. How do you handle this situation?
Yeah, I mean, that comes down to the proverbial, comparison with contracts against closings, right? So people that advocate, contracts are everything. It has a certain purpose, right? It tells you what happened 2 weeks ago, right? That the contract went to the offers accepted, went to the attorneys, contract was signed. Maybe it's 2 weeks old, but it's about as close as you can get to the meeting of the minds in quantity. The problem with that is, in certain periods, contracts fail 30% of the time, right? So, which makes it sort of like, is that super reliable in and of itself? But then you have closed sales, which are, lagging, because not only is it the close date, but it's the recording date, meaning when they become visible to the world. And and this is something that that Kael and I talked about, that I think is in part of this idea of like trends versus sort of like granularity and understanding and breaking down, is that when you think about like the end of a period. So let's say, we're coming up on the end of February, it's less than a week away. And so think about all the closings that occur in the last couple of days of February. They're not, and if you're reporting on, early in the next month on what just happened, right? A lot of that closing data is not recorded yet. So it's going to be missed, and maybe you're only capturing 85% of the market.
Or significantly less potentially.
It depends, right? It depends on how quick the city is, which, there are periods where they're, where they're way behind in recording, they're backed up, or
the recording date is a measure of government efficiency.
It is. And so, and then you have litigation, like, we've had, buildings, a building on the
years.
279 Central Park West. I remember, the closings occurred like, in public record, like several years after they actually closed, because litigation delayed the recording process, right? So you have all this stuff. And so one of the things that I've learned in my 3+ decades of doing this is public record sucks. Like, as a, like it's seen as like hallowed ground. It's the be all to end all. But it basically sucks, and it's enabled you two and myself to, find niches in sort of, alternative. But the point I was making was that.
Well, can I jump in on that?
Yeah, sure.
When you say that, are you talking about New York City and how complicated it is here?
Okay.
Because in other markets, it's not so bad.
No, I mean, I cover for Element their footprint over the US. It's over 40 housing markets and growing all the time. There are markets where the data is pristine. Right. I mean, it has all the hedonics, bedrooms, square footage, everything. And here it's very primitive. And yet we're like the financial capital of the world, like numbers and everything, but yet we're like 1950s, generally. Tremendous transparency over the years, last 20 years in terms of data, but the quality of the data, especially in the transactions, is horrific.
Yeah.
And we actually, in our reports, we actually use 2, 3, 4 sources to coordinate to get all, when we're using say a sale and appraisal, we use like 3, 4 data sources to sort of triangulate and determine what that sale is made of, short of just, talking to the broker.
We find that there's about a 4 to 6 month lag, a 4 to 6 month lag. For example, COVID's a great example. Everything was delayed for the pandemic, right? We all know the bottom of the pandemic was sometime mid 2020, like whether it was May, June, July, somewhere around there was the bottom. Like that was the highest fear, barely any contract signed. But if you signed a contract in May, June, or July, you were not closing that apartment until January, February, March of the following year.
Absolutely.
So what typically was a 3 to 4 month lag of closing to contracts was now like a 6 to 9 month lag. And if you look at all the data, this is a perfect example of what we're talking about. You look at all the sales data, the bottom is early 2021.
Yeah.
Right. Clear. So if you go back to mid 2020, it's falling. And that's the 6 month, in that case, probably a 9 month delay. The only thing we think we could do is look at some contracts, but we don't have that contract price.
Exactly.
And that's we only see
very interesting aspect of this, which is the contract price is hidden.
Yes.
Right. The buyer's agent isn't allowed to say anything about it.
And they're protecting the commission, right? I mean, they're,
and the seller as well.
Yeah, seller as well. Exactly. Totally understandable.
Seller's agent could disclose it if they wanted to, but they're not going to.
What did you think about during the pandemic? I was really outspoken about this because it really irritated me, was the delays in recording days on market for, Street Easy and Rebney ended up capitulating. But I was super against it. And the reason I was super against it is you never screw around with market data, and never, ever, ever, ever. And the brokers were saying it was to protect the sellers because their feelings were hurt because they were stuck for 180 extra days or whatever. And it's like, but the whole universe was in the same boat. It wasn't like just this property. And that's why I was just I was upset about it.
I mean, look, it was a rough time. I agree with you. What we did is we published both.
Oh, yeah. Okay.
Right.
Yeah, we tracked both as well.
Yeah,
okay.
This is the way we were asked to do it. This is what really happened. Here's both numbers, you pick.
Gotcha. Okay.
Can I just jump in there?
That's very diplomatic. I like that.
Well, I didn't want to manipulate the numbers, but I understood.
You were delivering, you were addressing an issue that was.
That's what they wanted, and we did it, and we're happy to do it. But
good for you.
We need consistent numbers, methodology over the years, right?
Yep. The trend is your friend.
The trend is your friend
until it ends.
So one of your audience members, Noah, Jill Libman, asked an interesting question. Like, I track condos. I don't track co-ops. And that was a very conscious choice because of the nature in which, condos exist versus co-ops. The way the data works, right? How the ownership works.
Yeah. Size data specifically.
Yeah, square footage.
Price per square foot is one of our look, everyone goes price per square. It's the linear price. You don't want to look at median sale price, guys, for linear price action. You want to look at price per square foot. And that's, in the condo sector, we got that written down somewhere on a record.
Yeah.
Right, so I love what you just did. And I love the way you do this when you do your webinars where you take out your little tool. Right.
Yeah, no, the John Madden's, the little pen.
Right. Yeah.
Yeah.
Yeah, no, and the other thing, it's interesting because I know there's been like lawsuits about square footage with co-ops because it's not anywhere, and it's not. There's no official record of it, and there's been efforts by different brokers to try to like create that sort of by default. StreetEasy has done that with sort of, they get a hold of the square footage, or the broker does, and then it ends up being this unit line is always 4,500 square feet,
Right.
when it may be, we measure it 18 times and it's 4,250, or, it's what we find when you actually measure it versus sort of the estimation, almost universally, there's about a 10% difference.
Right.
It's 10% adjusted up than what it actually is from the get-go.
Yeah.
Yeah.
Yeah. And apartments tend to have a very unique feature in Manhattan. They grow over time. I don't know if you knew that.
Yes.
They
yes.
do. Yeah.
Yeah. They expand.
Yes. Yes. Absolutely. The Empire State Building right now, I had a friend, or is a Chrysler Building. He literally is paying for square footage that's about 10 feet outside of his window. And that's and I think if I remember this correctly, the Chrysler Building has doubled in square footage, in leasable square footage, since it was built.
Wow. Is that where the lot line is? Is that what's going on there?
It's called expansion, like just like, let's round up.
Natural expansion. Send some questions in, guys. There's some questions. We'll get to the questions. We're gonna leave 10 minutes at the end of the questions, and we got a couple things. We're gonna go over some what we think about the market. Don't worry, we're gonna end with that. But Kael, I want to just answer. I want to ask one thing of you. Weekly, monthly, quarterly.
Oh, reporting.
What's the dealio here? Yeah. What are we? I mean, there's so many different methods. Give me some thoughts on that.
Yeah, so we do daily. We send out basically a daily report of like what happened yesterday. That goes to our customer list, and people are hungry for it. And I know this because something like 50% of the people open that email every day who get it. So people want to know. It gives you, kind of keeps you in the flow of information. We're all trying to get in the flow of what's happening. Yeah. With our endless, doom scrolling. But so I think, in the old days, I don't want to say old days, but initially when the data was, less available, it took more work to produce reports. It's quarterly.
Mm-hmm.
But to us, like, quarterly reporting is just not that relevant anymore. It's a good thing to have. It's a nice giveaway to give to customers. But in terms of like actionable, right, we try to do daily, weekly, and then we do monthly, and then we do once a year to kind of wrap it up.
Sure.
Right.
Although the downside to daily is, first of all, we have different purposes because most of my stuff is quarterly, although my rental data is monthly. The size of the period of reporting is sort of based on the amount of data that occurs in each period. So, that was actually how when I started I do a decade report, a 10-year moving window, and I've been doing that for like 20 years. And initially, I didn't have a Chelsea condo market. Why? Because there were like there were like 4 condos a quarter. Now I do, because there is. So the data size, I think,
for trends, that's key. If you don't have enough data, the thing is a mess. So I look at that, and so if I was doing it from your perspective, yeah, daily makes a lot of sense. It's just there's a different purpose for doing it. And I think that's how you determine, what kind of report you're doing. Like, there's something to me, like when I see a report come out and it says, hey, new signed contracts over $4 million are up. There's 4 more this week than there were last week. Being a trend person, that tells me nothing, right?
Yeah.
But to somebody in the trenches that is trying to get a gauge on things, it's very helpful, right?
Right. They're also trying to win business.
Yes, exactly. Create excitement, some optimism or whatever. And I get it.
Just know who did what, where.
Right.
Right.
And that purpose is perfect. I think if you're analyzing data numbers, I think a day might be a little noisy. I think I agree with Jonathan. We do weekly, as you know, we do the weekly and the weekly reports. Even that's kind of noisy every once in a while, but you do see some trends. You definitely see some trends. You see some pickups. But it depends on what it is too. Like if you're looking at supply, right? If you're looking at supply or pending sales, you can look at that daily because that's a pool of listings. You know, if it's closed sales, like you may want to go monthly in that. You may want to go, and even that might be a little volatile.
Sales started here, right? You want to know that like the next day. Offering plan got accepted here. You want to know that because everyone's racing to get in.
There's a timeline.
Yeah, to be the guy. Be the person. So it depends on what you're trying to accomplish.
Yeah. And I think that there's a big need. I think there's a big, I don't know how to explain this. A false need created that you have to give everything out first and be the first person to give it out and be ahead of the curve. It's a false feeling. You know what I'm saying?
It's
you don't have
creating a sense of urgency.
You don't have to be the first person to get it out. As long as you're consistent and you're accurate with the data and you're really representing the true trend, I think that's more important than being the first out the gate to do this kind of thing.
I mean, this is a really interesting point that you see in a lot of publishers, right? I want to be the first guy with it, or I want to take a step back and I want to be more accurate or more inclusive.
Right.
Yeah.
The New York Times doesn't want to be the first person to publish a story. They're going to let a bunch of others publish it first, and then they're going to come in and kind of wrap it all up and try and add more of a big picture view.
Exactly.
It's dangerous. It's dangerous for a broker to get these things wrong and be first and get these things wrong and have a hit on their reputation as an advisor or as a market expert, and because they got something wrong and then they have to correct it later on. You know what I'm saying?
Right.
I would definitely protect your rep in terms of that.
Yeah. Also, I think
data is wrong a lot.
Well,
it changes because like the quarterly data, like sorry, Jonathan, the quarterly data that we put out, you check that stuff 2 months later, it's different.
Right. There's a saying, right? The plural of anecdotal isn't data. And I get a lot of calls from journalists saying, hey, this broker said only left-handed people are buying studio apartments or some, crazy, I mean, I'm exaggerating here. And then it gets, it's in a blog post, and then it's in a story, and then it's in it keeps elevating. And then you're saying, what's the source of this? Well, it's just one agent who said, all my international clients are gone, like they're not buying. And then that becomes the headline. And it's like, no, it was that one person's experience, which is valid to them, but it doesn't speak for the market itself. Mm-hmm. And so a lot of times with, smaller data sets or smaller sort of point, a basis for judgment doesn't speak to the whole market or to that segment.
That brings up a really interesting thing. I think that's the difference between you two guys, which is more of a kind of trader's mindset.
Yes.
Versus a market.
I know where you're going with this, Kael.
Well, then jump right in.
I'm gonna let you say it.
Well, Noah's background, besides being a real estate broker, was a day trader, right? And so, I think the way he sort of processes the market is, what's a tradable event? Like, right, exactly. Right? That's how you're thinking of it. And because you're helping people navigate. I mean, this is my interpretation. It may or may not be totally accurate, but and you look at the market based on like, this sort of you use words like bid ask, and like you look at the market in a short-term burst way, but not blind to long-term. And I don't have that at all.
Right. So
I never realized that.
People talk about
that's how I see what you do, which is impressive. But I don't have that background or ability. I look at it in a longer view because I look at the at housing
Yeah.
as a longer term asset.
It's a slow moving asset category.
It's a slow,
Slow.
heavy.
Do you know why? I know why. It's because the stock market. I'm a trader. I'm definitely
All right, so you're admitting to it. You're admitting to it.
It's almost a fault. I can't turn it off. It's like it's crazy.
Don't turn it off.
I gotta,
No, it's a skill.
Don't turn it off.
But it's a little bit of obsessive. But I know why, because the
Another
stock
podcast.
market is a leading. It's an imperfect future discounting mechanism, and it doesn't look in the next 2 or 3 months. It doesn't look past a year because that's too far out. It looks like 3 to 9 months.
Yeah.
Right. So that's why sometimes you have a corporate an earnings report and it's really bad, but the stock goes up, or it's really good and the stock goes down. They're guiding for the future. They don't care about now.
That's already built in, right?
Priced in. That's what they say, priced in. So that's kind of, I think, now that you're bringing it up, that's kind of how I look at Manhattan, but I never really connected the two.
Yeah. I think that's a great way to describe it. And so it's a different sort of approach. Mine is more a longer term trend, external factors. And yours is sort of a short to medium trend, the way you look at the future. Yeah.
I'm trying to figure out changes in leverage in real time on the short to medium path because I can't see too far out. That's the only reason why. So like if buyers are losing their leverage, I want to put a piece out about that so the agents can send that out. Or if sellers are losing their leverage.
Gotcha.
That's the only mentality I have, is to try to like find out those signals when it's going the other way.
So that's your market pulse, huh?
That's that's why we built it.
Yeah.
I think it's going up, by the way. This market. Let's shift to the market for a little bit.
Okay.
We got some questions. Okay. This market is percolating. I'm seeing deals coming in at a very brisk pace right now. Let's go around the horn. First off, is this down cycle different than past cycles?
Absolutely. And my dad, and I'll tell you the one reason it's different, and I hate, and this is my dad joke. I say this every time, like I hate people that say this time it's different. But this time it's different. And the only thing that makes it different is that inventory in my 40 years has never been the factor that it is now. Like, normally when there's a pivot, what's that?
Being tight.
Yeah. Okay. So in every cycle I've been involved in, the narrative is an external event like rates spike. And so what happens? Sales slow. Gee, we saw this in 2022, right? And then inventory, because sales are slowing, is piled to the sky, right? But that's not what happened, right? And so in this cycle, you would expect then price correction in a big way, when you have such a drop in sales. But that's not happening either. And the reason it's not happening is because inventory is unbelievably low, and not just in New York, in the 40 plus housing markets I cover. And there's still bidding wars, right? Less than there were.
Unbelievable.
But there's still bidding wars.
Scary at the same time. The Fed has more work to do.
Exactly. I think we have, at a bare minimum, we have a couple more 25 basis point increases, but it's kind of humorous to think, people saying, boy, I hope there's a rate cut soon. It's like, you got 3.4% unemployment. Why on earth you're looking at it only from housing's perspective?
So just to explain what Jonathan just said real quick, and then Kael, we'll get your thoughts on this. There's something called the Fed Funds Futures Curve, which predicts where they think the Fed's going to go with their terminal peak rate, which is around 5, and it's rising. 5.1's going up now. And where they're going to go after,
where it's going to peak,
and where it's going to go after, it's looking at like a little after a year and a half, and they think it's going to cut by the end of the year. They're going to cut rates, and I think what Jonathan's saying, and I'm in that camp, is there's no way that's going to happen.
Yeah, I think it's more in 2024. First or second quarter would be my uninformed.
I agree.
But I look at that, and so what was the question? I forgot. I'm so off on a tangent.
Is this down cycle different from past down cycles?
Oh yeah. So the difference is supply. The rest of it, it's screwed sort of the typical flow. And so as a result, we're not going to see a price correction. We're going to see single digit plus or minus, in terms of pricing as a wildly general statement. Unlike the Lehman moment where we saw 30% overnight and the agents are coming to me and saying, there's all these low ballers. They're all offering 30% below, last month. And I'm like, that's the new price. But we're not seeing that. And even with the inventory rising the way it has over the last year, it's still, 50. This is one other point I want to bring up before I finish. It's still significantly below pre-pandemic. And so this is my other point. I just was curious what you guys think about it. Is one of the observations I had starting in the summer of 22 is that the macro narrative about the housing market was wildly negative, like over the top negative, because we were seeing, year over year sales declines of 40, 50, 60%, depending on the market. And I felt like we're comparing against 21, which is a rocket ship. And we're saying, hey, but sales in 21 from 20 went up, I'm making it up 100% or whatever. And now it's down 40%. So I felt like the narrative needs to be, for proper context, not narrative, but for proper context, 21 was this wild anomaly in sort of historical sequence, and we need to be comparing against pre-pandemic.
Yeah,
Probably another quarter or so. We're coming to the end of that world because there's enough time that's passed to give proper context. Otherwise, you think that it's a dystopian hellscape and we're all going to die.
Right. Well, let me jump in. So I totally agree. It's all a question of perspective. What we did in our market reports is we created a 2015 to 2019 benchmark, right? That's the 4-year period before the pandemic. And so now what we're doing is we're comparing everything to that. And
excellent.
Right. And so I don't know how that fits with this kind of, trend. It doesn't, we're taking into account the kind of an anomalous nature of what happened.
But is this time different, Kael? Is this time different?
Well, I don't know. I mean, the way I've been looking at it, I'm just looking at how the pendulum is swinging. And so, early as we've gotten into 2023, the pendulum kind of swung a little below the benchmark period. So things were down a little bit.
In terms of transactions?
Price, transaction volume, we were a little bit below, not much. And so we see this head faking based on what people are thinking are happening with mortgage rates and, income to price. But we've already seen now in the last couple of weeks, now it went above the benchmark a little bit. And so we're kind of doing this, up and below it. But generally, we're not that far away from where we were before.
Yes.
Yeah.
So things are, even though we might all not feel so normal right now because we're coming off this big, we've been saying sugar high, it's pretty normal compared to where we were.
Yeah. And I would just add that the reason I think this is different this time is because the Fed is raising interest rates and keeping interest rates high into a slowdown. And usually that doesn't work.
It's the other way to,
Usually the slowdown comes, the Fed stimulates and lowers rates and provides liquidity to help the situation. This time's different because But
let's look at a little farther, right? So these rise in rates, if we look at, what's happening right now in the office market, you're seeing now, some of the debt and offices starting to trade.
People are going on to watch lists, right? That seems to be the regular news cycle now.
You got a few things combining there. You got, the whole, what's happening to that asset class, but then, are people going to the office? But then separately, the debt that those offices were acquired with has now, the rates have gone up. And so now that stuff is starting to trade because it becomes a way to buy a office property by just buying the debt, and maybe they're going to default and you're going to get
the property
control of that asset. Right.
Yeah.
So I've been watching that, which is a separate aspect of what's going on here in New York. And then separately, you have like looking farther out into the future of what's getting built. So, we have, and we haven't talked about this at all, but you got the 421A and what's happening with that, and will people be able to build stuff? And then people who did get the 421A, can they get financing? You got some other complicated things going on. Going back to what we said about, you have all these different aspects of the market which affect each other. These things will come into play also.
Yeah, I think we're going to be debating for the next 5 years about the viability of office to residential conversion, right? And one of the, which seems like it'll happen on the margin, but not in scale, because it 5 years is a small window, and sort of, in terms of zoning changes and the millions of dollars to sort of retrofit. And also the biggest issue is the floor plates, right? On a lot of these full block office buildings, they don't work.
Yeah. I don't want to take this too far off topic, but for any of that stuff to happen, it's going to require very significant government intervention.
Which the government does not, New York City does not have. Like, when you think about 49% of New York City's revenue comes from real estate.
Right.
And and here we have the office market, being reset.
Yeah.
So,
I apologize. I know I just went way.
No,
yeah, that's all right.
No, that's totally okay. Listen, I think we should shift to Q&A. We got about 10 minutes left.
Sure.
There's a couple of questions in here. Let me see if I can quickly, let's hit some quick answers. Kael, this is for you. Do you have reliable information on shadow inventory? Is it per building only, or do you have data from Manhattan or New York City as a whole?
All of it. Yes, it is reliable. I can tell you, the market peaked at like 14,000 and change, unsold units. During the pandemic, we kind of boiled down maybe 2,000 of those. There's still 12,000-ish.
That's all of the boroughs.
Yeah, in all 5 boroughs. Principally Manhattan to a degree in Brooklyn, and it's on Marketproof, it's by building, by neighborhood, by borough, city.
And is that trend going down? I would imagine it's going down.
Right now it's pretty stable. You got new stuff coming on, you got stuff coming off. Right now we're at like 12K.
I mean, I would have thought that new development over the next couple of years is going to almost have an inventory crunch, because I don't see the economics and feasibility over the last couple of years and now.
So the quantity of new stuff coming on is dropping, but also the pace of sales is dropping.
Right. So the absorption rate or the sellout rate is similar. Pretty
consistent. So we're like, right now we're like, I don't know, call it 4.5 to 5 years of inventory is available. It peaked at a much higher number, but that's a healthy number. In New York City and other markets, that would be very unhealthy. But in New York City, it's pretty healthy. So yeah, we have all that.
Okay, good stuff. Let's move on here. Public records definitely sucks. I can say these kind of words. It's our own thing. How best to work around it here? Just use the MLS numbers. I mean, let me just tell you something. Public record doesn't suck.
What MLS?
There's a lot. MLS sucks. I take that back. Public record is the verify point. It's the verify point. We look at it as the verify. We can't rely on the brokers, the MLS data, to show us the closed sales data. So we look at it as the verify point for sale date, sale price, et cetera, et cetera. It sucks in terms of its inefficiency and its lagging nature and its errors and all that other stuff. But the MLS, I mean, these MLSs, again, Kael and I had a 10-minute conversation before this webinar about whether or not we should go into all the issues with the MLS, and we decided not to.
Right.
We decided not to, and we didn't want to go into the weeds, but trust me, the MLS has a lot more work to do, in my opinion, to get up to par than Acris. But curious.
Right. Well, what's interesting is around the US, the brokerage communities live and die by the MLS systems. Like, they are the lifeblood of the real estate community, and they are, for lack of a better description, they're, as I said before, they're pristine in comparison to what we have in New York. New York is just 1950s in that regard.
Yeah, this is such a complicated topic, and I have so many things that I want to say, but it's too big a conversation.
Yeah.
It's too
We
big
could
of
have a separate
conversation.
episode just on this.
Yeah, and yeah, I don't even want to touch it. Okay, let's go
go.
see if
Move
there's where's your data coming from? It sounds like for condos, it's Attorney General filings, but where else, particularly on rentals? I don't know who that's directed to, but I mean, I'll just Rebney RLS,
Yep.
MLS, Acris. There's other MLSs, I guess. Kael, I don't know. Are you getting it from public record
Our
sponsor
data?
filings? Yeah.
Yeah, we get it from, a lot of places. Yeah, from AG, from Rebney, Brooklyn MLS, One Key, we're Department of Buildings,
Right.
City Planning, news stories, all of the above.
Yep.
Jonathan?
Yeah, and
anything to
rental
add?
data obviously isn't public record. So we get a lot of that from Rebney, Douglas Elliman. They have relationships with other sources as well. And, it's certainly a constant challenge because you can't verify, an actual transaction the way you can in a closing on a sale.
Can I
Agreed.
hijack again?
Sure.
Sure.
Somebody asked a great question for Jonathan. Since there's no central repository for rental data and most of the market is open listings, where are you getting data on rents and signed lease volume for your monthly reports? Jonathan and I just had a long conversation about this in another video we did. It's on you can see the video, it's on YouTube. And this is a question I get asked a lot about the asking price and the leased price. And Jonathan, I'll let you speak, but the important thing is that because the vacancy rate is so low, go ahead, you jump in.
So first of all, we actually on my housing notes, which is my Friday newsletter that goes out at 2 p.m. Every week, I have this cool chart where I show active rental inventory for Manhattan against the vacancy rate that we track, and they're freaking in stereo, like they just go together pretty closely, although I like vacancy rate better. In terms of sourcing for rentals, we get that out of Rebney and we get that out of Douglas Elliman, and Douglas Elliman is a very large company, and we get actual rents, but not in the context of all the entire market. And for the ones that we don't, what we do is and this is all in a methodology. All my market reports, I have a methodology link on the bottom of the last page of every report that takes you to a methodology page on my website. And although I don't update the methodology as often as I should, but the idea is that we build a discount rate for based on the overall market, that we have the transactions and apply those to the ones that we don't. The reason why that's not a big deal in my mind is because the discount between actual and asking in the context of the last 5 or 6 years, there's hardly any discount. There's not a lot of, there's not a lot of negotiation going on rents. I think you see more of that as you move higher in price, just like you do in the purchase market. But it's, in terms of establishing trends, in my mind, it's a non-issue.
Okay. Thank you, Jonathan. We're going to move on here. About 5-6 minutes left, but we'll stay over if we can. This is an easy one. I'm just going to answer this unless you guys disagree. When you have square footage value for co-op apartment, where is that coming from? That is from the listing systems, Brooklyn MLS, Rebney RLS, the agent generated data.
Right. And let's just say that is not totally reliable information.
Right.
No,
the data is only as good as the agent that puts it in.
We use the square footage that we actually physically measure. And if we don't have that, we know the A line was 1,253 square feet, and we appraised the apartment above the sale that just occurred in the building. We're going to use 1,253. The floor plan's the same. We can see that. So we use that. And then what we don't have, we look at the same, those sources that you just mentioned.
Okay, very good. What is your best source of data for Manhattan luxury market? Is it still the Olshan report or something new? Thank you so much. I love Donna Olshan. I love the Olshan report. I think she goes above and beyond, and she has her own sources of information that may go above and beyond revenue sometimes. So I think it's very thorough, consistent. I still review it every single week. I don't know if you guys found something different, but Kael, Jonathan, thoughts?
We do Donna's report comes out on Monday.
Yeah.
We do a luxury portion for new development. Hers covers, co-ops and townhouses, and ours just covers new developments.
Okay.
So just different slice, the same stuff. So I think I look at what Donna's doing. I look at our report. Jonathan, maybe you have something to add there.
Don't take this the wrong way, but I hardly read anybody's reports.
I mean, you have enough to do on your end.
Yeah, and I like she's a does a wonderful job and all that, but I don't like, what does it mean in my life? It doesn't really like impact what I'm doing in terms of what I present. I also publish contract data, but it's monthly, it's not weekly. In our new signed contract reports that we cover in 4 regions in the US, the New York metro area, Florida, Colorado, and Southern California, which is by price tranche. So I can see, 4 million and above or whatever. It's good to know that people rely on it, but it's not something, and it's not just that report, like
no disrespect,
any other,
makes sense.
no disrespect, because all the quarterly reports that are done by other firms, I don't really look at those either. Like, because what am I going to do? Say, oh, they're saying there's 17 sales and I think there's 18.
So unless you're Jonathan Miller, you could listen to the Ocean report and be fine. Let's move on.
We got to invite her into one of these episodes.
Sure.
We'll get her on. If you could wave a magic wand, what would you change about the New York City property real estate data that you could obtain from city, state, or other sources? Kael.
Good question.
Excellent question.
It's a great question.
Don't ask me. I don't know.
I know the answer. I know the answer.
This is a frustrating one. DOB has been undergoing massive changes to their systems. And it's really hard, and they're taking stuff away. So at the same time, they're adding stuff's getting dropped. It's really frustrating.
Inconsistent.
It's tough. So I would try to wave a wand to fix the DOB system today. Okay.
That's an excellent one. I would just say have one listing sharing system that actually has the data.
Mm-hmm.
Is that too much to ask? I know there's a lot of agents that don't put their stuff into the system and they get violations, and Remy's doing it now. But I see it. I have agents, hey, why is this on Street Easy and it's not on all the other sites that are up here? It's not on, just share your listings. Just share your listings. You know how hard it is for co-broking, right? It's the Wild West still. And I just wish it wasn't the Wild West. So that would be my one. All right. How long are you projecting down the market for New York? How long and Manhattan luxury? Kael.
How long what?
Are you projecting the down market for New York?
Is that sales or prices?
I imagine
got to be sales mostly.
The depth,
it's going to be that long.
Duration. Okay.
Yeah,
I think by middle of the year we should be in a much better place. Assuming that nothing changes, something.
Right. Well, that's a big assumption, right?
Yeah.
I think we're going to have a pretty active spring. It's just not going to be on steroids, right? Especially I'm encouraged by the uptick in activity that I'm starting to see now.
Right. But is it a head fake, or what's going to happen?
Well, the thing is, to me, I think where we really start feeling comfortable with future trends, or near midterm trends, is when the Fed stops, and just sits. Because every quarter, we're introduced to another variable, another unknown, and it's hard to see this as like stable, right, until we stop seeing this. And
Yeah.
My guess is if we're lucky, it'll be by the middle of the year.
Yeah, and I think that I think the duration of this is going to be a little longer than we all would like it to be, in my opinion. And we're going to be chopping along the bottom right now. We're chopping up right now. We're actually bouncing up right now, and this could last for a couple of months easily before it fades. So strike and ride the wave.
Absolutely. I mean, rates have really risen quite a bit in the last week or so, and that may take. This little burst of the last couple of weeks may disappear in the next couple of weeks.
Well, don't say that. It's going up, and we're deal volume world, and I like more deal volume for everyone. Look, you can have a couple of good months. I worry that there's another wave, another risk-off wave. So I worry about the next 3 to 6 months, right around what you guys say. But let me tell you, if that wave comes, I think it'll be a generational buying opportunity, because I think the depth of that wave down is going to be a little more severe than the one we just went through. And it might be a little more painful. And if that happens, that's going to put Manhattan right kind of at that pandemic low area. And you know what happens with Manhattan when you're in that area. Only the few people that do bid, that have the courage to bid when there's blood on the streets, will get rewarded at the end.
You got
I love it when you talk like
look
a
at that.
stockbroker.
Right. See, there it is again. There's that trader mentality.
Buy when
Bad earnings came out.
I am crazy. I was telling you, I'm a contrarian trader. I'm nuts. I do something really, really stupid. I like to buy low and sell high.
Oh, wow.
Oh, that's
I love it.
I've read books about that. Yeah. Yeah.
So when the carnage comes, keep your dry powder ready.
You are not a momentum trader. No, you're a contrarian trader. Do you want to jump in? Do you want to do another one, or should we wrap up?
I think we're pretty much done here. We're over time. We're going to keep people coming. Look, we're going to do this every couple of months or something like that, and we'll try to make something going on. I'm trying to add these consistent little events to UrbanDigs. But this will be recorded. This will be put on UrbanDigs. I will give it to Kael and Jonathan to distribute in case you missed this. You can find it on our site. But listen, thank you, Jonathan Miller. Awesome stuff. We rarely just sit down and talk. So
this is fun, and definitely want to do this more often.
Yeah, we will. So that's Jonathan Miller of Miller Samuel, Kael Goodman. Check out Marketproof, guys. Awesome stuff. I'm Noah Rosenblatt of UrbanDigs. Thank you guys for coming, and we'll catch you guys next time.
All right, guys. Thank you.
Bye.